I want to thank all three of you for being here today, and we're going to get right down into it because when we talk about the strategies here for addressing climate change, for reducing greenhouse gases, curbing emissions, improving the environment, you have a variety of infrastructure needs that have to go along with that, and presumably a variety of finance needs as well to go along with that. So when you talk about trying to create a financing approach, financial solutions here, and I want to start with you, Jason, there is always going to be that question here in the finance industry of prioritizing ROI, prioritizing other sort of return metrics. And the question becomes, how do you prioritize those things and at the same time move climate, ESG, and some of those issues into that same priority universe?
Great. Romaine, thanks so much for having me on. And it's a great question because this is the one big issue that we're all trying to get more comfortable with. We're effectively trying to grapple with. Call it sort of balancing the fiduciary duty or the sole purpose test with these non-financial ESG or climate-related issues. And in fact, actually, we saw this sort of bear out in the recent Department of Labor ruling around ESG as sort of a non-pecuniary factor within ESG analysis. I think the starting point is first, focus on the data. That sounds simple. Yes, I know, but the reality is we don't have a lot of it, which inherently sort of makes us a bit comfortable, particularly from a quantitative finance perspective. We're used to sort of looking at decades and decades of different economic cycles. The data now that we're looking at is different. By our measure, we have around 12 years worth of unrevised data that we can look at and sort of run simulations and stress testing around climate risk. That's not a lot, but we do, kind of looking forward, have to recognize that this data isn't, in any way static. It's being shaped by changing regulation, clearly, carbon markets, extreme weather events, et cetera. So I would say, focus on the data and clearly working and applying that within risk models, particularly, sort of larger, sort of general asset allocation models, where even now you find that climate risk as a factor really doesn't formally appear.
Yeah, it doesn't formally appear. And of course, one of the reasons why you're here, Jason, as well as Alexandra and Akash, is the idea that we've sort of gone through some sort of evolution, I guess, is how we approach addressing climate change through the world of finance. And Alexandra, I want to come to you here because there is sort of concerns here of sort of how you sort of create commitments here within the finance space, whether you're talking about what asset managers are doing, whether you're talking about what investors are doing, and of course, what the banking sector itself is doing. Can you address that issue?
Yeah, absolutely. And good morning and afternoon to everyone. And thank you for having me on here, Romaine. I think you're absolutely right. And actually, we now are at a point in time where we need to continue to close the gap between the commitment and action. Specifically at BNP Paribas, we have two key pillars here. One is to encourage the sustainable growth in the economy, which is, generating a positive impact, through our products and solutions, but equally developing our contribution to society. And here it is the adoption of supporting the energy transition. And I think what we recognize is that we've got to accelerate the allocation of financial resources towards this positive business developments, while also enabling the mitigation on these negative impact sectors. I think society's really understood that finance has strong levers at work to help the world actually tackle some of these immense challenges. And we can't underestimate what these challenges are, both related to climate and increasingly biodiversity. We've got a massive role to play in terms of from a leadership standpoint, and really thrilled that actually someone like BNP Paribas has actually been strongly engaged in the fight to climate change for a number of years now. And what we try and do now specifically is to work to align its activities with the objectives set by the Paris Climate Agreement. Now, back in 2018, we actually signed what we call the Katowice commitment, and we joined the collective commitment to climate action in September 2019, along with being a founding member of the Principles of Responsible Banking. So therefore, we have committed in developing tools which bring its credit portfolio in line with the objectives of the Paris Agreement. But you rightly may say, well, what does that actually mean? And actually, it does involve many elements, because you've got to be able to identify as well as analyze and manage these climate-related risks and opportunities for not only us as the group, but also for our clients. And I would say there are 5 key areas. One is obviously financing, be it the likes of the renewable sector, but also having and developing innovative financing and investment solutions, which I touched upon before, and also investing in some of these innovative startups. We also mustn't forget our own operations, where we've committed to being carbon neutral, as well as what we mustn't forget, which is really important here, is having our own stringent and tangible sectorial policies, such as reducing exposure to the thermal coal and unconventional oil and gas industry. And I'd like to say that we've actually seen this come through tangibly within our energy mix by in having such sectoral policies. And what we saw in 2019 in particular was that 87% of the project findings we granted in the electricity generation was devolved to renewables, whereas 0% was to the coal-related projects.
All right, so you've got a strong commitment here coming from your organization itself. And I want to bring Akash into this conversation here, and maybe he can make the link between not only what his organization itself is doing, but sort of what type of feedback or what type of responses you're getting from clients on this particular issue.
No, it's a great point, and thank you for having me. And it's a pleasure to meet everyone here today on this panel. You know, we come at this from what we consider a fairly unique and comprehensive perspective. And that's because we're a different kind of financial services company. On one hand, we're a platform that has nearly $40 trillion of invested securities that we help manage the data, the custody, and other administration on behalf of our clients. And it gives us a view into really what's happening, where are people actually putting their money, where are the flows of assets actually going over the last few years. And then the second is, you know, we're one of the world's largest investment managers with nearly $2 trillion of assets under management. And obviously being a responsible investor on behalf of our clients is an important part of this. And I think to address the question directly, I think the most important link we're hearing from our clients is help us educate ourselves and help us define what sustainability, climate change, and importantly, ESG investing really is. We just actually did a survey of our wealth management clients, and more than half of them said, you know, I'm interested in doing ESG investing, but I really want to know more about what that actually means for me. And I think that is going to be the central question and role for financial services companies like all of us here, is helping educate our clients on what factors and attributes really matter to them. How do they fit into a broader context and framework? And how can they make actions in the types of investment decisions that they want to make?
Well, then that circles back, Akash, to something I guess that Jason had brought up just a couple of moments ago about looking at data. And our audiences are able to submit questions. And we've gotten a couple of questions already, including one, Jason, asking about what type of data is pertinent to risk modeling and sort of, you know, being able to sort of make the decisions with regards to these investments.
Yeah, it's a great question because there's so many different types of data out there. On one side, you have absolute-oriented climate data. You also have ESG data, which tends to be an ordinal kind of rankings relative type data set, which I think is less useful for understanding climate risk and risk modeling. What we've seen is some real maturization in these data sets. There's still, I mean, to be clear, some problems in it, but I think you can look one at forecasting data. Well, let me say this: you can look at simply commitments. You know, what commitments are companies making, and what is the nature of those commitments, do they square with certain issues? The number of companies in the oil and gas industry, for instance, I think have made some problematic, you know, sort of ambitious commitments around net zero on a 2050 basis. You can also look at climate data. Unfortunately for that, much of the climate data on a company-specific basis, the horizon doesn't go out far enough. We're talking about 5+ years, effectively a normal kind of planning cycle for a company. So there are some defaults where you can look at sectoral climate data as well. You can also look at Paris alignment type data. The Transition Pathway Initiative is one such data set where you can look at a portfolio and sort of understand how aligned or unaligned this is relative to a 1.5 degree rise in global temperatures, and then start to sort of also overlay that with simple like carbon assumptions, on the belief that, at some point we will start to see the emergence of a better linked global carbon market. And at that point, you can start to do sensitivity analyses, stress tests, look for sort of distressed assets from a carbon perspective.
So a lot more questions coming in here from the audience. They specifically want to know a little bit more about some of the tools that any of you have developed to sort of further their goals towards this. I don't know if Akash or Alexandra, one of you wants to jump in on that one.
I'm happy to
very
start.
happy to.
Go ahead, Alexandra. Why don't you? No, please go ahead.
Thank you. I was just going to say, on the lending side, mentioned to you that when we signed up to the Katowice agreement, one of that was to, ultimately develop a common methodology, which is also an open source platform, which is now available to all banks who wish to work to align their balance sheets towards the Paris Agreement. And this was developed by the 2 Degree Investing Initiative for measuring and aligning our own portfolio in line with the Paris Agreement. And actually, we took various sectors, and actually the ones which we took, no surprise, were those ones which represented the greater proportion of greenhouse gases. Now, don't get me wrong, I mean, it's still work in progress. PACTA is promising, and we can already use it to set practical targets, measure alignment, report on commitments, and define next steps. And actually, we've seen over 20 universal global banks now around the world, which are currently working on this particular approach. We ourselves use it for our loan book on various high carbon sectors, be it the fossil fuels, be it electricity generation, transport, steel production, and cement production.
Akash?
Yeah, we've focused a lot on providing transparency and actually helping address the problem Jason also raised, which is there's a lot of data out there, but often of spurious quality. So one of the things we've developed is an ESG app, which aggregates tens of thousands of indicators that would be attributed to individual corporations, data about carbon and climate change. And what it does is it not only aggregates it and allows you to select at a fairly definitional level of what attributes matter to you to screen securities, but most importantly, it has a crowdsourcing element to it so that by definition, the highest quality and most used indicators rise to the top. And it's something that we just launched earlier this year. We have several hundred investors on it already. And it's a remarkably powerful tool to start really getting at the question of what are the data elements that really matter and who's really providing them in the quality that we need.
So Akash, how much knowledge do your clients typically have already about sustainability, climate change, ESG, et cetera?
It varies considerably. And, we're a US-based bank, though more than half of our clients and revenues come outside the US. But I think, and I'm curious, we'll have a different perspective here based on our US investors versus our non-US investors. But starting with our non-US investors, I think the public pension and investors are truly leading, and we hear a clarion voice from them of what they want, the standards they want to set, and the expectations that they have for us. When we get to our sovereign wealth clients, they're starting to explore this with more seriousness. Obviously, in the Nordics, you see that the most. But as you get elsewhere in the world, they're interested, but coming in from behind. But the client area that I think there's the biggest opportunity right now, especially to set standards and also feed into regulation, are central banks, who I think, by and large, are at a very early stage, especially outside of Europe, in setting standards for the rest of us. So that's what we hear from our clients or see from our clients outside the US. In the US in particular, when we look at our institutional clients, what they're trying to do is find a way that they can explain to their investors ultimately that investing in ESG does not curtail performance investment returns. And I think particularly in the US, that's a sensitive topic of being able to manage that through data and transparency, but also on outcomes because we just don't have enough track record yet.
I want to go to Jason here for a second. I mean, particularly on your point about central banks and potentially picking up the mantle here. And I'm curious as to, Jason, whether there are some examples here where we started to sort of see, I guess, a move in, I guess, a shift in the regime of sort of how this is sort of a push forward. I mean, are we moving away from the general incentive model that maybe has been out there for a while?
Yeah, so I completely agree. In fact, what we're seeing, particularly out of Europe, is a sea change in terms of how sustainability kind of more widely and specifically climate risk is being addressed. You're seeing that right now from a regulatory perspective. It's called the Sustainable Finance Disclosure Regulation that is going to really sort of change the way we think about products and address issues around greenwashing. But I think even kind of pulling back a little bit from that, what you find from an EU perspective is something that maybe didn't look very clear a few years ago, but now is looking a lot better aligned and orchestrated, a bit more mosaic-like. You're finding within the European Investment Bank, they've changed their funding policy for unabated fossil fuel that late last year that had a knock-on effect with the EBRD. You've also seen the ECB change its asset purchase program from brown bonds to green bonds. And now you've actually started to see the introduction of, I would call it conditionality. But the EU would call it alignment. But the idea is that, as you federalize loans going forward around these issues, the expectation is that countries, and this will trickle down to corporates, need to sort of align themselves to achieve that 2050 EU net zero target.
And so, Alexandra, more questions coming in here from our audience, and they really want to know about some of the types of training out there, or that could be out there, that would be helpful to them to sort of get more up to speed on this.
No, and it's a very good question. And I think this is what the broader industry needs to focus on, because I would use a quote which Einstein often says is, we cannot solve the problems with the same thinking we used when we created them, in the sense of we've got this big problem, be it around climate or be it social issues. And so it really is going to take a big mindset shift while also understanding the fundamentals of the environmental concerns and the social concerns. And actually, it's been able to translate what we're dealing with into financial language. And actually, when I took this role on, I came up with these 7 R's, because you can relate back to them in all incidences, which is, be it it's risk, it's return, it's regulation, it's your ability to recruit and retain your employees and your talent. And ultimately, as Jason mentioned, it's becoming, a requirement as more governments actually set net zero ambitions, which we'll see a lot more of during the course of this weekend with the Climate Ambition Summit happening. And then let's not forget your reputation. And I think the training, therefore, really needs to resonate with the audience. And what we found is that you really need to bring in a lot of external experts. And actually, we've worked very heavily with the Cambridge Institute of Sustainable Leadership. We've put over 150 employees through that. But at the same time, we want to ensure that all of our employees can understand this transformation which is going through the economies. So we ensure the whole 200,000 employees across 70-odd countries have that baseline understanding. But I think the reality is it takes lots of different sources to get this training done, both on the analytical side, but actually real live examples. We find that the biggest uptake and understanding of what we're dealing with and grappling with is when people hear it directly, both from the client's perspective, because they realize it's very real and material, and we are going through this transition that's required. And we mustn't forget, we want it through the whole value chain, be it from the onboarding, be it the KYCs, be it to risk, be it the business to actually identify the business opportunities. So it's actually both front and obviously back office across functions and front office staff. But I do, stress that, sustainable finance is one where you've got to work with all stakeholders across society to really get a good understanding of what this agenda means for all of us.
Akash, I'd like to hear your thoughts on that as well.
Yeah, I agree with everything that's been said, but I'll also say that the moment is now, and I say that because we're reaching a generational transfer. I get a group of millennial managers together on a regular basis, as I am one, and it's a number of us are in senior management roles, really shepherding, I think, the intergenerational moment that we're in. And one of the things we talk about is how sustainability and really understanding how that plays through as a manager will be the same importance of a skill as like learning how to use Excel or PowerPoint 25 years ago. It's going to be something that we're going to have to be able to do in every decision that we make, whether it's about where we choose to invest, how we lead our people, how we build the next generation of great companies. And I think that the kind of training that we will all need is going to be so comprehensive, and we're in the very early stages of being able to provide it for ourselves. So I'm really looking for others to jump in here, and from the academic world, from the business world, and the broader community, because I think there's a lot more to learn.
And so once we start going down this path, at some point, you come back down to investors and clients who are going to not only look for results, but they want to sort of make sure that there is sort of a sound methodology in evaluating progress on that front. And I guess, Jason, I'll start with you on this question is sort of what is the methodology that we have right now where we can make sure that the assessments we're making are accurate?
I think I would say that it's very individual. This is an incredible time where firms are investing heavily in terms of trying to develop frameworks internally and borrowing from standards frameworks or other areas. And effectively, what Akash had said was something about an analytics tool. We've also built one within our firm. I think you're seeing many managers and asset owners build these, taking these sort of often very disparate data sets and adding some proprietary research and investment and trying to sort of divine something out of whether it's ESG risk or more specifically carbon risk, and then apply that within portfolios. Obviously from a risk perspective, risk management perspective, but also trying to see what sort of you can find from an alpha perspective as well.
And some of the tools and the products that are out there, I mean, our audience is asking this now. I mean, where can some of those things be found?
I mean, I would say that, sure. I would point to, I mean, there are some very well-known data providers, MSCI, Sustainalytics, Bloomberg is obviously in the game, RepRisk. But what you're finding now is, particularly if you're quant-oriented, a lot of focus around non-traditional, very alternative data sets out there. And those can be, whether it's social media or applying tools like natural language processing or machine learning into areas, and again, trying to sort of marry different kinds of analyses or think of different types of horizons. So you can build something that is very sentiment oriented, which tends to be sort of a near term factor, with something that is maybe more economically intuitive over a long term basis.
All right. And then sticking on this topic of, I guess, the methodology to sort of measure and finance these commitments. Another question coming in here, Alexandra, and I'll pose this to you, is how closely your organization is aligned to SASB and upgrading your reporting towards those standards?
No, I think that's a very valid question. Actually, we've seen recent reports coming out that companies that adopt ESG focused alignment towards SASB, in particular the defined material issues, actually realize a 4.8% bump in annual outperformance, while those firms that don't actually realize a 2.2% penalty. So we are seeing both clients, especially within the private equity space, really start to ensure that the disclosures and in reporting is increasingly more aligned with organizations such as SASB in terms of the reporting. We mustn't forget also the work, when it comes specifically around climate, with the TCFD reporting. And here, this is something we've been a very strong advocate of, because all of these methodologies ultimately needs the disclosure in the first instance. So that is obviously something that we continue to work with to ensure that that is enhanced, as well as more broader scope in terms of coverage of the disclosures.
Akash, to you as well.
Well, we're focused on. So I'm going to speak first as a bank, right, and about the reporting we do ourselves, and then talk about how we enable the industry. I think what we're committed to at BNY Mellon is taking an aggressive stance towards transparency. So we will be publishing our sustainability report in the next few weeks. We're going to be very clear about the data that we feel very confident about sharing and how we're progressing, and also where we're going to be investing to build additional transparency. And one of the things our management team's committed to is setting near-term goals as well as longer-term ones, because we just can't, we can't allow investors to manage us quarter to quarter on our financial performance, but then give us 30 years on our sustainability track record, right? So we're trying to bring them more into cohesion, and that's going to be the big plan for 21.
All right, only a couple minutes left, and I want to pose this question to all of you here as sort of what you're expecting to see out of the next big UN conference. Obviously, people are looking towards COP26. What are you expecting to see? Do you feel businesses are ready for the changes, and what can they do to prepare for those changes? I'll start with you, Akash.
Well, I think we're mindful of what we hope is going to be a tonal shift towards action in the new year. I think we're mindful of a administration change as well here in the U.S. and the role that the United States and our institutions are going to play. In some ways, over the last few years, our banks and businesses have been leading the government, and we look for more cohesion to that. So that's something we're excited for.
Jason?
Yeah, so I would completely agree. From bringing the U.S. into the fold of the the global conversation again, that's going to be incredibly refreshing. I think there's a lot of work to be done around carbon pricing from a global perspective. I think that there is, in the new administration, I actually do think that there is bipartisan support there. I also think that we're going to see more companies sort of push on commitments, and I would even say harder commitments, longer term commitments. So more constructive for in terms of investors trying to sort of understand this.
All right, and
then I'll just quickly conclude with I agree with that, and I think we'll also see a greater focus on the private and public sectors coming together, and that's been a real focus area of ours, and that's really what's going to start transforming a lot of these sustainable finance solutions, is a greater collaboration between the public and private sector.